Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribbled down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. And now for this week's question.
Is my life insurance company safe? Good question. I have absolutely no idea. It depends on the life insurance company you have. So this question came back, and this was back when Silicon Valley Bank was having some trouble. And if you remember that almost seems like ancient history now. But the questioner goes on and asks me, if SVB can fail, what's to stop it from happening to life insurance companies? So again, it depends on the life insurance company, but for the most part, I mean, I'd say like 99.9% of insurance companies you've ever heard of, they don't fail, and they don't fail for a very good reason. So there are many ways in which life insurance companies and banks are similar, but there are also many ways, and one way in particular that separates banks from life insurers. And while a run on the life insurance company is technically possible, it is nearly impossible to pull off successfully and bring down the insurance company because of a run. So let's start with banks. Banks are in a very interesting position. So they have to accept deposits from customers and then make those deposits available for withdrawal immediately. So the technical name for this is demand deposit. And demand deposit accounts are the primary banking products that banks sell, really. It's checking and savings accounts. So we don't really think of checking and savings accounts as financial products because there's really little or no explicit fee for these things. Like most people are not paying a fee to have a checking account. Some businesses are. I mean, if you have a business checking account, maybe. But for personal accounts, you typically aren't paying. Like they're paying you interest to keep your money there. But rest assured, they do cost the bank money to operate. So part of the operation of a bank's deposit account involves providing capital to back up the account and to make sure that depositors can access their funds, when they need them. So, I mean, that's kind of the whole point. Like when you write a check against your checking account, you expect the check to clear. Likewise, when you go and you make a withdrawal from your account, you expect the bank to give you the money. I guess people aren't, maybe I'm a little disconnected from the market a little bit in that market, but I'd wager a guess that most people aren't withdrawing cash from bank accounts these days. I think most people are using apps or credit or debit cards or whatnot, but maybe there are people who are actually taking cash withdrawals. Anyway, the point is that when you go to a bank and say, like, I want my money back, you expect them to have the money and to give it to you. So but here's the funny thing. So banks tend to only keep just a small fraction of total deposits on hand at any given time. So in general, the amount that a bank will keep in reserve for unexpected withdrawals hovers around, I think, 10%. 10% of total deposits. So if a bank receives $100 in deposits, it's going to keep, maybe $10 on hand available for withdrawals. The rest is going to be lent out or invested somewhere, and that's how the bank is going to make money. So this is how it is basically part of the bank's, I guess I would call it the bank's operating system, right? Quote unquote operating system. A bank can't really function without doing this. It has to take deposits and then turn around and figure out ways to make money with them. Otherwise, there's no point of the bank existing. The banks are just like any other businesses. They have to figure out ways to profit, and they make, the main way that they do it is making loans, Well, where are they going to get the money for the loans, right? Depositors, right? That's primarily where they're getting money from. They don't have money of their own. They're taking money from other people and using it to make money and then giving it back. So 10%, of total bank deposits doesn't sound like much. And so what happens is because it's not. So what happens is, if all the bank's customers show up all at once and demand all their money back, that's called a run on the bank, right? So, what happens when people do that? Well, the answer is you get the situation that happened with Silicon Valley Bank, which is a run on the bank, and everybody wants their money back, and the bank's like, oh, we don't have all this money all at once. We don't have it all right now, but we can get it for you, but it's going to take time. So what caused the bank run is a subject. It's a subject that you could probably write a book or maybe a couple of books about. But what's important to note here is that banks are vulnerable to bank runs, and of course then the bankruptcy that follows the bank run. So banks sell liquidity. They sell access to your money in your checking or savings account. So when you open your checking account, you expect to be able to write checks against that account, withdraw cash, whenever you want, and so on and so forth. It's like, duh. I know I'm pointing out kind of the obvious, but I'm trying to just set up like the difference here between banks and insurance companies. So the kind of liquidity, and I don't want to get the impression that this is bad or that it makes banks weak. It's a feature of banks. Okay. It's just what they do. It becomes a problem when the bank holds low yielding bonds like they had been for, at that time they had been because the interest rates were really low. They were low for like a decade. At whatever 1%, 2% or whatever, the yields were really low. This was before yields turned around. So when the bank holds low yielding bonds, which a lot of banks are still having because they're not matured, so they haven't rolled over yet. Interest rates rise, and and the net withdrawals being made. Let's say, okay, so it's the bank holds low yielding bonds. Interest rates rise. There are net withdrawals being made from the bank, and the bank has large capital losses on its books. That's a recipe for failure. Okay, it's a recipe for catastrophic failure. And that's what's happened to SVB. So, and not just them, like it was happening at other banks too. So, if you get low yielding bonds on the books, you've got interest rates that are rising, and then you've got a bunch of people who are like, yeah, I'm moving my money out and putting it somewhere else. Yeah, that's a very bad thing for a bank because they can't meet those withdrawals, and they're booking losses. Like they're booking losses. If they have to cash out low yielding bonds and their rates are rising, like they're actively losing money, right? So they have to give the money back to their depositors, and they're losing money at the same time. That's not good, right? So, and at the time, that's what had everyone spooked about what they called contagion. So they were worried about net withdrawals being made from the bank. In other words, more people withdrawing than depositing, and they were worried about that happening to banks all across the entire U.S. banking system. So, what about life insurance companies? Can't this happen to life insurance companies? And the answer is, well, let me get to this. So life insurers invest in the same kinds of assets that banks do. Surprise, surprise. They're investing in bonds, right? The main difference with life insurance companies is that life insurers are not, for the most part, selling liquidity. And it's weird because I talk all the time about how whole life insurance has liquidity, right? Universal life has liquidity. Like life insurance contracts do have liquidity, but that's not the primary thing that they're selling. They are selling future benefits, and the life insurers have many, many ways to control liquidity where banks do not. Okay, so insurance companies, the way that insurance companies are buying investments and hedging risk, that's the main reason why life insurers have survived for as long as they have. There's nothing magical here. There's no trickery going on. They simply control the risks that banks cannot control, and thus they are structurally more stable. It's just the way it is. So this is why, as I've written many times before, and I've written about this on my email list too, if you're a member of my email list. It's very important to understand, especially for the folks that do the infinite banking thing, because I know there's a lot of them out there, and we talk about infinite banking this and infinite banking that. Your life insurance policy is not a bank. Let me say that again. Your life insurance policy is not a bank. You have to get this into your head. And I assure you, you are happy about the fact that it is not a bank. I don't care what the infinite banking folks say. It is not a bank. It has never been, and hopefully it never will be, because you don't want to be subject to that type of risk. Now it is a source of personal credit, and that's where we can get into a discussion about that. But whole life insurance and some UL policies are a source of credit. You can have, it's basically personal credit. Every dollar of premium you pay goes into the cash value of the policy, and that becomes equity that you can borrow against. So that becomes personal credit. So, and yes, you can access your policy's cash value in a way that looks very similar to, but is not actually similar to, a bank account. These are very subtle differences, but they're important differences. So one way that it's different from a bank account is that life insurers have very tight control over liquidity and liquidity risks. Okay. So how do life insurers control liquidity risks? Well, they do that in several ways. So first, life insurance companies do not engage in fractional reserve banking, and they keep 100% of deposits on hand. But usually they're invested in a variety of different investments. Okay. So another way is that life insurers back up all guarantees themselves with large capital reserves and segregated surplus funds and interest maintenance reserves. The surplus at most insurance companies typically amounts to somewhere between 10 and 15% of total assets, while capital reserves are usually in excess of 100% of the cash values of the of whatever the total insurance products on the book. So the interest maintenance and asset valuation reserves bolster the company's surplus funds. So they're just like kind of adding more money to that thing. On top of all of that, so basically you have so a long way of saying you have massive capital reserves. Okay, that banks simply don't have because it's just not conducive to their business model. On top of all of that, okay, you have state guarantee associations. The insurance industry's version of FDIC is essentially what it is. Now, I'm not saying that this is the greatest thing in the world. If it were me, I would be doing it a little differently. But the fact is, there are guarantee associations, and life insurers pay into a general insurance fund that backs up everyone's deposits at all life insurance companies in the United States. So every state participates in this, and every life insurance company participates in this. The SGAs are designed to be a last resort backup fund. And they would typically insure up to $100,000 for cash values and $300,000 for death benefits. Another thing that is different about insurance companies, another way that they protect themselves and policyholders, frankly, is that there's a fundamental lack of bulk demands for liquidity at life insurers. So one of the problems that plagues banks is, and in this context, because this questioner was about Silicon Valley Bank, but banks in general, is that SVB was essentially a mega community bank serving a narrow population. So its customer base was mostly startups or people and companies working in a highly speculative tech industry. Now, at one time, this was considered its core strength until rates rose, which fundamentally threatens growth-oriented companies. You have to think about the market that they're serving, okay? A market that has a high need for liquidity. Contrast this with life insurers that generally have a broad and diversified policyholder base, combined with the fact that cash value life insurance and annuity products are generally seen as long-term savings products, not short-term transactional banking products. And thus, insurance companies don't have large numbers of policyholders running to them demanding big wads of cash all at once. They just don't, right? You're not writing checks out of your life insurance policy. So a run on the life insurer would cause a loss of benefits. Again, the main benefit of banks is the liquidity of funds. That's what they sell. The main benefit of life insurers is future benefits, not current benefits, future benefits, future savings and future income benefits, plus future death benefits and old age insurance. So tapping cash values of life insurance always comes at the cost of a decrease in very valuable insurance benefits. And policyholders mentally know this, right? It's painful when you borrow against your policy. It's like, I need the money, but I'm also decreasing my future benefit. So many policyholders are reluctant to do this. And when they do, they almost always access policy cash values through loans, and they're committed to repaying those loans. Like, some people aren't repaying the loans, but you have an agent come to you and say, like, look, you borrow against this, you're going to decrease your benefits, pay back this loan. That's what I say to my own clients. And that's what I do on my own policy. I know when I borrow against my life insurance, it is the future benefits go down. So I want to make sure that I have a schedule to pay that back. So money's always going back into the policy. So, and plus premium payments, right? So access to cash value is typically done via loans, right? So this has a natural effect of making people think twice about accessing money in their policy, and then also paying the money back, right? So policy loans are not free. If people don't pay them back, they risk losing their life insurance policy and paying a bunch of taxes on any gains that are made in the policy. So that's a huge, huge disincentive to raid life insurance policies and encourage policyholders to treat their policies with more respect than, say, like a bank account or savings account where cash withdrawals are seen as free access, like no penalty, like penalty-free access, right? No penalties for taking money out. So the mindset of a person borrowing money is very, very different than a mindset of a person making a straight withdrawal. Surrender charges is another way. So low liquidity early years. So surrender charges don't really apply to whole life, but they do to universal life. And there's a lot of ULs out there. So life insurance is notorious for having low liquidity in the early years of the policy. And critics bitch about this endlessly, right? Which is why everyone knows about it. But it's also sort of this hidden in plain sight benefit that makes itself obvious during times of financial stress. This is all designed for protection, right? Protection. And there's stuff that's built in that people will look at and they're like, that's stupid. Why do they do that? Yet you don't see it because it's there to protect you. And once, it's frustrating sometimes to have people criticize life insurance when they don't fully understand why something is done a certain way, and then when it actually protects them, they're like, oh, I didn't know that. Oh, that's a good thing they did. Oh, geez, I didn't realize that. Yeah, you didn't realize that. The actuaries built that in there for a reason, you knucklehead. Okay, they did that they didn't just arbitrarily do this because they're like, let's see how we can screw policyholders. It's the whole thing is meant to hedge and transfer and protect risk against risk. Okay, there's a reason why all this stuff exists the way that it exists. Anyway, another way that carriers are protecting themselves is just through really in some ways ignorance on the part of the policyholder. So lack of liquidity awareness on the part of the policyholder. Most policyholders simply don't know they can access their policy's cash value. Personally, I find this kind of weird since my career has been spent educating people about the living benefits of life insurance in addition to the death benefits, the latter of which everyone knows about. Everybody knows about death benefits. Policy loans account for a very, very, very small portion of an insurance company's portfolio, and a small percentage relative to the insurer's total assets. So at the old mutuals like Northwestern, Mass, Guardian, New York Life, I would even include Penn Mutual in this, and One America, and a couple others. But definitely the big four. Policy loans amount to between 5 and 7% of a company's assets. That's not much. It's small. Another way that companies are protected is deep cash holdings, right, and reoccurring premium payments. So on a whole life, let's say policyholders suddenly woke up to the idea of infinite banking, or just to the idea that they could tap into their cash value of their whole life or UL policy at all. Well, then what? Well, life insurance companies, especially the old mutuals, hold sums of cash on hand to meet loan requests, more so than banks do, right? So in fact, strong life insurance companies have cash positions in excess of their unrealized capital losses. So, Penn Mutual, Mass Mutual, Northwestern, Guardian, New York Life, all of them. Notice anything about any of these names? These are, all of them, the old mutuals. They're not the only ones in this position, but they are the most prominent. And then life insurers also do something that banks do not do. They require policyholders to pay premiums to receive benefits of their policies, their insurance policies. So every life insurance policy has a premium requirement. Arguably you could say, maybe not ULs, but we'll get to that in a second. So whole life insurance, term insurance especially, term and whole life. So whole life insurance is especially sensitive to ongoing premium payments. So regular required premium payments must be paid every single year, which creates stability in current and future cash flows at the insurance company, right? And as a side effect, liquidity, right? So the importance of steady ongoing premium flow cannot be overstated. Banks have no such requirements, and as a result, experience wild swings in deposits and withdrawals. It's not really as easy to predict that. So when a life insurance company They know they're getting their guaranteed level term premiums. They know they're getting their guaranteed level whole life premiums. And even though Universal Life does not for GUL, they know they're getting their premiums because you have to pay the level premium on that. For index ULs and current assumption ULs, you say, well, there's no guaranteed level premium on there. No, but there is a planned premium. And again, it's more like psychologically, like mentally, the policyholder is sort of primed to pay that planned premium. It's not required, but most people end up paying it, right? So definitely for term and whole life, and then just psychologically, there's a strong influence on people paying their universal life premium. So the insurance companies kind of have this idea, like they know they're getting the premiums from their policies, and for the mutuals, they know it for a fact because it has to come in. The premium either has to come out of pocket, so policyholders have to pay premium out of pocket, or it has to come from the policy values. The policy will pay for itself, right? So one way or another, the premium is coming from somewhere. The company's getting the premium payment, so they can book the premium revenue. Yet another way that insurance companies are protected is the 6 month provision, something that a lot of agents don't like to talk about. And then they see it as a negative and kind of this dirty little secret kind of thing. I don't think it's a dirty secret at all. So during the Great Depression, life insurance companies survived while banks routinely failed. That's like a little bit of history not a lot of people know. Insurance companies, so banks would fail because of this, the run on the banks. People tried to do a run on the insurance companies, but it didn't work. Okay, so today's liquidity crisis is, when the stuff that happens today, like when you see, let's say like back in 2008, this was happening, and a couple of years ago with the SVB, this was happening. So when you see these liquidity crises that happen in today's markets, those kind of hint at why insurance companies are so strong. Like there's like a clue to the past, right? So they control the liquidity in the policies to prevent panic from bringing down the insurance company. So baked into every single life insurance policy is a 6 month liquidity provision, meaning if there is a run on the insurance company, the life insurance company can slow down withdrawals and policy loan requests so that they do not run into the same type of situation that plagues banks. During the Great Depression, life insurance companies did not halt requests. They actually did keep the policy loan, the money flowing. What they did was they slowed down requests for money. So you could go to your insurance company and they would process requests for like emergency funds, to pay rent, to buy groceries, to make necessary debt payments. Like if you needed money, they give it to you, right? But they would delay requests for luxury purchases or total surrenders. So they wouldn't let people panicking bring down the insurance company, because some people are retarded. And they will, they'll just go and they'll give me all my money, but they panic, right? And then they make stupid decisions, and those stupid decisions bring down the company, right? So insurance companies don't allow that. They don't let a small number of really stupid individuals bring down bring down an entire company. So people got the money they needed. Okay, it wasn't, don't get me wrong. If you needed money, you got money from the insurance company, and you put in your loan and they would process your loan request, but they were not given immediate and full access to all the money at once. Okay, so they could space out withdrawals and loan requests up to 6 months. There's a hard 6 month cap. So that's what saved the insurance companies during that time. And it protected policyholders too, because policyholders, like if you had just a small number of policyholders going crazy, they could damage the other policyholders at the company. So it was protective of everybody. Okay. So like I said, it saved the insurance company, saved the policyholders, in the process, basically created this legendary status, of the life insurance industry, that people still know today. Like people know, and when they start learning about life insurance companies, they get this idea when they learn about this. They're like, wow, life insurance companies have never. How does a company stay in business for like 150, 160? Some of these older companies, New York Life, Penn Mutual, they've been in business for 170, 175 years, right? How do you get a company that stays in business? And by the way, not just stays in business, but pays dividend payments for 175 consecutive years, every single year for 175 years. How do they maintain profitability there? It's in the way that these things are designed and run, and from the ground up, they're built to last. So all of the above, okay, and there's a few I'm probably leaving out, but basically all of the above are reasons why a successful run on the insurance company is essentially impossible. If something like that were to happen in the industry today, it would probably be very annoying. Lots of people would be very mad, and probably wouldn't, they probably really wouldn't understand what was going on. And they'd feel like the insurance company was slow walking the withdrawals and policy loans. And I'm sure there would be something in the news, and people, these people are being treated unfairly. You should give their money, not understanding that, look, we're doing this to protect you so that you get all your money back. And if we start selling off our assets into a collapsing market, you're not getting all your money back because it's going to start driving the price down. So, they would feel like, the insurance company's not honoring its promises, and I'm sure that the insurance companies would take a lot of abuse from the news media. I'm also sure that at least some policyholders would probably try to sue their insurance company to get their money faster. Those are the stupids, the no minds. They would probably hate the insurance companies for acting the way they did. Just like a child hates it when a parent yanks their delicate little hands away from the spinning blades of a running blender, that the child is playing with. But it doesn't mean the parent's doing something wrong. There's a saying that investors are their own worst enemy, right? Where we see this play out in the markets all the time, right? And we see this play out in the banking industry, and we see it play especially in the stock market, right? And for those reasons, life insurance companies put safeguards into place, and that's to protect hysterical and panicked policyholders from hurting themselves and others. It has to be that way. So anyway, that was a great question. I hope this provided some clarity on kind of why life insurance companies are different from banks, and whether or not your insurance company is safe. I would say in general, yes, your insurance company is safe. If you stick to the bigger companies, the old mutuals, your company is fairly well run. Yeah, your company is safe. And as of this recording, all of those companies are very financially sound and doing very well. So I wouldn't hesitate to put my money there. I don't hesitate to put my money there. That's where my policies are. So, so insurance companies are safe. They don't operate in the same way that other financial companies operate. And I'm thankful for that. And hopefully if you're a policy holder with one of those, you're thankful for that too. So it's a great question. Thanks for submitting. And I will see you next week with another question.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.